Welcome to today's Sparta Commodities webinar. Today we are presenting our fuel oil focus, so we'll be starting off with a debunking session on the upcoming ecozone changes in the Med. After that, we'll focus on the outlook for product cracks and refinery margins around the world. My name's Neil Crosby, I'm the head of analytics here at Sparta, and today I'll be your host. Joining me for this discussion are three of my expert colleagues who bring a wealth of experience and market knowledge. We have June, senior oil market analyst based in Singapore. She has 18 years at Shell. June has worked across refining, trading, and strategy, and she brings a wealth of insights from the refining industry. Then we have Phil, senior analyst and product expert based in Europe. Phil is an experienced energy market analyst with expertise spanning across the oil barrel and power markets. He's worked with myself actually at JBC Energy and with RP Global. And then we have Hoa, commodity owner, fuel oil, based in Singapore. Previously leading fuel oil analysis at Trafigura, Hoa has worked across crude, diesel, and APAC power markets. Now at Sparta, he drives the development of forward-looking tools for fuel oil and feedstocks. Now, before we dive into today's discussion, for those quickly unfamiliar with us, Sparta delivers real-time forward-looking market intelligence designed by traders for traders. Unlike traditional data analytics providers, we focus on actionable insights that help traders identify and capitalize on market inefficiencies. So, bridging the gap between price and value. With Sparta, you always trade with conviction. We have solutions already for gasoline, naphtha, middle distillates, crude, freight, and now fuel oil. So we already cover most of the oil barrel, providing our clients with a comprehensive cross-desk solution for actionable insights and intelligence. Very excitingly, as said, we are now offering early access to Sparta for fuel oil. To see it in action, contact us at sales@spartacommodities.com or visit our website. With that all said, let's get the content flowing. I want to invite Hoa to kick off our discussion on the ecozone. So I leave you in his very capable hands, and I'll see you all at the end of the session for the Q&A.
Thank you very much, Neil, for the intro, and a big hello to our audience. Welcome to the Sparta webinar. So one question we keep getting when talking to the traders is how we see the Mediterranean emission control area, or the MED-ECA, play out both in the short term and in the long run. There is obviously a lot of debate over the use of MGO, or ultra-low sulfur fuel oil, and the fate of the VLSFO market. And so we thought we'll be giving some of our views on this that may be a little bit different from the market consensus. Now, for a very quick overview of the MED-ECA, we are talking about 0.1% sulfur limit being implemented from the 1st of May onwards. And this can be done either through the use of compliant fuels, in which we have two options, either residue-based or distillate-based, or using the scrubbers. The MED itself is a pretty big area, spanning some 2,500 miles from the east to the west, and approximately 15 to 20% of global seaborne traffic goes through this area. The Med is very big for transiting, especially with normal Suez Canal and Red Sea traffic, and it takes roughly a week to cross the Med from the east to the west. Traffic based within the Med itself is also pretty big, but smaller than the transit traffic. Now, there are very big questions with both short and long-term implications when it comes to the implementation of the MED-ECA. Market consensus predominantly focuses on the use of MGO, and at the same time seems very bearish the VLSFO complex. So the questions that we would try to talk about on this webinar would be: one, will there be a market for VLSFO, and what kind of pricing will we see? Two, what will happen to all of the VLSFO supplies that are currently in the market? And we don't pretend to have all the answers, obviously, just a couple of thoughts that we have from our conversations with traders, with suppliers, with the ship owners throughout the last few months. Okay, let's first take a look at the current state of the market. On the left-hand side is our Sparta estimate for monthly consumption of the different kinds of bunker in ARA and the Med, where we have the active ECA zones from May onwards. In the Med itself, we're talking about 800 to 900 KT a month of VLSFO consumption, some 250 KT of MGO, and very negligible consumption of ULSFO for obvious reasons. If you look at ARA, where the North Sea and Baltic ECAs have existed for a few years, there exists a small ULSFO market of some 125 to 150 KT a month. With normal Suez Canal traffic, marine traffic linking Asia and Europe goes through both the North Sea, Baltic ECA, and the new Med ECA. And of course, this does mean bigger ULSFO economies of scale for both the owners and the blenders or producers of this. So the ships going from Northwest Europe to Asia through the Suez Canal, I think will likely pick up a little bit more of the ULSFO in ARA if they choose to use this kind of fuel. So now the question is, will they choose to do that instead of just using MGO, your gas oil? And I think it's very helpful to look at some very rough economics. And please do keep in mind these assumptions are really up for debate. And if you think about it, an eco tanker consumes anywhere from 10 to 40 metric tons of bunker daily at roughly, say, 11 knots, depending on the vessel size and cargo. On the other hand, containers tend to move a lot faster, 14 to I think 16 knots, and consume almost exponentially more because the consumption and speed curve is exponential. So now we can make a couple of assumptions. Let's assume it takes 6 to 8 days to cross the Med, and we have an average daily consumption of some 40 metric tons of bunker across all of the fleet. We also assume that ship owners require cost savings equivalent to at least 1 day of earnings, let's say $20,000 a day to be incentivized. Taking all of these into account, we look at a minimum of some $50 to $75 differential between ULSFO and VGO and MGO for the 0.1% residue to make economic sense to the ship owners. In any case, what is going to happen to all of the VLSFO that are currently in the market? On a previous slide, we talked about some 800 to 900 KT a month of VLSFO being consumed in the Med currently. Does this mean that all this is now useless and we start moving to, say, the east? And the answer is not really. The fact is that there is still a lot of demand for VLSFO for the non-ECA portions of the voyage, whether that's the ships starting or ending their journey in the Med, where taking VLSFO for their journey is still important, or for the ships transiting through the Med. But for those ships, I think perhaps they're a little bit more likely to fuel in ARA or Singapore or the Far East. So when it comes to VLSFO supply, you have two main sources. You have the on-spec VLSFO from the refineries directly, and also the blending of components at certain central hubs to get on-spec VLSFO. So on-spec VLSFO supply directly from the refineries is something that those with refineries will have to think carefully about, perhaps trying to pull as much of that into the other pools if the economics make sense. Uh, but when it comes to the blending part, a lot of the VLSFO blending in Europe is often a combination of two things. One, very, very low sulfur straight run residue, and we're talking about roughly 0.3% sulfur or below. And two, some sort of low to mid sulfur streams, which can range from 0.6% to up to 1.2 or 1.3% in sulfur. And one example of that would be taking something like Skikdal SSR, which is 0.2% sulfur, try to blend it with a 0.7% low sulfur stream from India, for example, to get on spec 0.5% VLSFO. So now, what is the implication of all of this? If you think about it, the 0.3% sulfur and below molecules, ideally below 0.2%, can actually quite easily head to the blend pool for the ultra low sulfur fuel oil. On the other hand, things that are say 1.2% or 1.3% can actually start getting pulled by the high sulfur fuel oil blend pool. So that actually leaves the low sulfur molecules of say 0.6% to 1.1%, and those may actually need to find a new home. So, but how would pricing for these new ULSFO blends potentially work? Looking at it from a supply perspective. So we show a theoretical result obtained using our proprietary blender, uh, with prices coming directly from our Sparta platform. The existing straight run residue streams, ideally 0.2% or below, can be blended with straight run gas oil to produce ULSFO. both are quite paraffinic in nature in this case. So I think we tend to run into maybe a little fewer compatibility and stability issues compared to using something highly aromatic cutters like the LCOs. So let's take an existing streams of residue like skip-down SSR, which is roughly 0.2% of sulfur, and 10 ppm, which is probably a little bit more expensive than some other streams that can be obtained for blending. In reality, skip-down SSR is landing at around, I think, $5 per barrel to Brent at a met location, say Malta, and 10 ppm is around $10 per metric ton to ICE gas oil, except for the viscosity, which will invariably be very low for this kind of blending. The specs all met. So we're talking about roughly, I think, $55 per metric ton discount versus MGO for this sort of blending in this example. So one thing I would note is that the pour point can be a problem for some of these blends that we're trying to do. Some residue streams like DOBA and SSR have pretty high pour points. I think that's close to 40 degrees. So that could be a problem. Okay, so now the question is, what other residue streams that can be used for ultra-low sulfur fuel oil blending in ARA and demand? And our focus obviously is on those streams that has, sulfur content of roughly 0.2% or below. And a lot of the existing residue streams are actually very low in sulfur and can work into the new blends. Things like Skikda or Azu or Gabon, LSSR with consistent supply all have sulfur around 0.2%. Ours is a little bit higher, 0.25. But these streams are also dominated by the feedstock takers. So that's also something to keep in mind. Dangote is another is another potential stream. And we have seen sulfur in the 0.2 to 0.25 range in the past. But I think the qualities and the supplies are a little bit inconsistent. And it also comes in very big parcels, 1 Suezmax, for example, and that's not something that many people are willing to take. The most promising, I would say, would probably be putting DOBA through the splitters and use the residue for blending. The residue sulfur is roughly 0.09% for DOBA, so that's already below the 0.1% limit before any further blending. And there's also pretty ample supply of all of this in general. We're talking about, say, 3 to 4 Suezmaxes a month, which is, a 72% mass yield, some 350 to 400 KT a month of potential supply of the residue. The one limiting factor, as we mentioned before, would be the high pour point of the DOBA, even for the LSSR, at roughly 39 degrees Celsius, which is pretty high. Okay, and now there are also some other concerns. MGO is obviously more familiar to most people, but ULSFO does have an advantage of simplifying the changeover process to and from VLSFO for the ship owners because both will be residue based. So you have fewer concerns over thermal shock, in the changeover process. When it comes to using the scrubbers with HSFO, it's very easy to scrub from, say, 3.5% to 0.5%. But scrubbing from 3.5% to 0.1% is 97.5% efficiency, which I believe is hitting the technical upper limit for quite a number of existing scrubbers. So those scrubbers may need a little bit of additional adjustments before it can actually work. There will be some concerns over the compatibility and stability of the new 0.1% residue blends versus MGO. But as we discussed, previously, perhaps a little bit less of a concern if the blends turn out to be mostly straight run residue plus straight run gas oil. That tends to be generally quite stable. Okay, so what is our conclusion here, if there is any conclusion? We think the impacts of the ECA on the VLSFO complex is probably not as bearish as people think. And we estimate potentially only 1 to 2 Suezmaxes a month of additional low sulfur materials from the Med to the east. Number two, we think MGO will take the lead in the beginning when it comes to the ECA compliance. But we also think there will be a market for ULSFO in the Med, with ARA itself also getting bigger in that regard. And we estimate at Sparta that the Med ULSFO market is going to be around 150 to 200 KT per month. So based on our assumptions, A $50 to $75 discount to MGO seems to be the kind of sweet spot that we're looking for this ultra low sulfur fuel oil market to exist. And with that, I would like to pass on to Phil, who will talk about cracks.
Thank you, Hoa. Very interesting. So I'm going to take a little bit of a high-level view, just give an overview briefly on where fuel oil and clean product cracks are, where they've been over the last couple of months, and where we are looking for them to head over the next month or two. So starting at the bottom of the barrel, thanks to the theme of this webinar, we'll look at fuel oil cracks to begin with. And the story of resid cracks as a whole, since about last spring, has been one of fairly consistent strength. I have on the right here a few different screenshots all mashed together into one, but in the bottom right here we can see the trajectory of a kind of rolling both HSFO and VLSFO crack. We can see that those have been strengthening consistently over the last 6 or 9 months. Now that has changed in the very prompt, especially for the low sulfur cracks, but we'll get onto that in a second. Focusing on the high sulfur residue market, we can see that that has been led by sanctions particularly, but also the continued crude slate lightening and refinery complexity increasing fundamentals that have been a theme of the market for the last few years, and a fundamental trend that isn't going away. If we're looking ahead now, though, into Q2, for example, all eyes are actually more on the geopolitical and the kind of the macro risks, rather than the underlying market fundamentals necessarily. So eyes on US policy in particular, with the one side being US tariffs, so tariffs on whether that is either Canadian or Mexican or both oil into the US would in particular have a very or an immediate impact on tightening the high sulfur residue market, on redirecting those high sulfur both crude and resid markets, and overall giving a little bit of a boost, especially to the Atlantic Basin high sulfur markets in the short term at least. And obviously on the other side of the coin, we have the potential for Ukrainian peace deal, and specifically the potential for the US lifting Russian sanctions, which could essentially flood then the US high sulfur residue market in the short term as well. The last one on that, so there's a lot of things to balance here, would be the increased sanctions, or at least the increased application of sanctions against Venezuela and Iran, with the Venezuelan or the allowance for Chevron to be lifting Venezuelan crude running out in the short term. That's on the whole going to be tightening again the heavy and high sulfur market in the Atlantic Basin. If we look to low sulfur resid markets, then also has been driven by tight fundamentals, with some of that low sulfur resid being pulled into the secondary refining space that the missing high sulfur resid has historically filled. But we've seen over the last few weeks in particular, and that's the on the charts that we're seeing on the right hand of the screen, the left column here is our LSFO or VLSFO Singapore blend margins. And we can see that over the last month, those blend margins have been starting off in mid-February very, very high and coming down fairly consistently. And so what that has meant is essentially we've been tracking very strong VLSFO blend margins in Singapore for the last few weeks, and that has really pressured the cash market and the time spreads in that market in particular. So we've seen on the one hand open blend margins in Singapore VLSFO, and VLSFO cracks following gasoline cracks lower as those have come off across Europe in particular at the beginning of this month, but globally as well. And that leads us, I suppose, onto the next slide, which would be to look at the light ends markets. And I'll get to gasoline in a second, but just to round off naphtha very quickly. Naphtha's been one of the relatively the bigger winners of the last, again, 6-9 months or so. So we've seen strong intermediate markets, so strong kind of naphtha and fuel oil markets on the whole. And the Med in particular has been benefiting from kind of stop-start Russian flows over the last few months. And the thing that we've been seeing most prominently recently has been Med physical premia that have been rising First on a pull from Northwest Europe at the beginning of the year, when there was good blending and storage economics, and now the pull to the east as margins in the east have improved, and that has opened, or the improving situation in the east has helped to further raise the physical premium on those naphtha barrels in the Med. Now, for the prompt, or for the next few weeks, I would say, we have a narrower, much narrower now prompt gas nap spread in Europe, which is definitely going to put a ceiling on the European naphtha market as a whole. Now, that's more of a Northwest European market issue than a Mediterranean. The Mediterranean still has this strength from the open arb into the east. And the very final thing on naphtha that I'll mention very quickly is that, and it's linked to what I mentioned before about the Venezuelan crude then being missing from the market, is that this year I think something to look out for on naphtha will be more pressure coming out of the US, and especially the US Gulf Coast. So there is actually a lot of US Gulf Coast naphtha to place, and especially with this lower quality and diluent stream that typically went to Venezuela now having to find a home. We should see diffs in the US coming off, and those barrels needing to find a home elsewhere, either in the Atlantic Basin or in Asia. So on gasoline, the biggest story at the moment is that we have bloated European stocks. And that has come about essentially because the winter has been spent trying to tie up prompt component availability into long-term storage. We had a very large contango. We had open blend margins essentially for blending summer spec already back in January, which means that it kept winter gasoline markets fairly well supported. But that all starts to fall apart as you get towards the end of Q1. Essentially, we've seen over the last week or two that as the market starts to try and trade April, all of that summer spec starts to appear, and it starts to really pressure those prompt markets. Now, again, tariffs are something which is are a big story, also in gasoline markets, and so whilst the on again, off again tariffs from Canada, or on Canada rather, from the US, serve to open up the transatlantic arb, so the arb out of Europe into Pad 1. That is actually closed again already today. And so that had been seen as a potential source of support for European gasoline, and to help chew through a lot of these inventories that appeared. But that now seems to be slightly weakening unless those tariffs really come back on. And obviously there's the flip side of the potential for US tariffs on European oil, but we'll leave that for now, I think. And just finally on the gasoline, to look at Asia very quickly, the Asian market has comparatively been it's been quite strong over the winter. And it did so partly on an expected lack of Chinese exports. Now, the market had a wobble over the last week or two, partly following the European market, but also because there were suggestions that Chinese runs and gasoline exports could head higher, with some of the state oil companies looking for additional export quotas, reportedly at least. Now, finally, on middle distillates, we'll talk about diesel and we'll finish off on jet. Middle distillates have also seen a fairly strong start to the year. We had a cold winter in Europe, which pushed up natural gas prices. It pushed up demand at the margin for heating oil as well. And importantly, the swing barrels coming out of the AG, or the West Coast India, were all pointing to Singapore for a long time. And that now has started to turn around, both from a macroeconomic and from a physical market perspective. So obviously on a macroeconomic perspective, we're talking about the potential for recession in the US and elsewhere, trade war, tariffs, lower consumption, all not great things either for diesel transportation or for industrial activity in general. So the bets now on diesel cracks essentially have been coming off, and that's coincided with some of the prompt physical arbs opening up into Europe as well. So the US Gulf Coast, the Red Sea, even the swing barrels from the AG in India for very prompt loading, all pointing towards Europe. So we would expect April in particular, ice gas oil to look lower. picture does improve again from a physical market perspective from mid Q2 onwards, but we still have this kind of underlying, now relatively bearish macroeconomic sentiment to deal with. So we now have a balance, I suppose, from mid Q2 onwards of the physical market looking stronger again, the ARBs not being open into Europe, but we have this underlying macroeconomic issue. And finally, on jet, the ARBs from HE in West Coast India, these swing ARBs, for the majority of the beginning of this year have been pointed very much into the West and very much out of Europe and the US, been pointing very much towards pad one, into the US. And what has happened since then is that, well, US inventories have been soaring in recent weeks. That has been on a combination of weak demand, strong domestic supply, and consistent imports, as we've seen from those swing imports. Now, the flip side of that is that Northwest Europe jet diffs have improved recently, kind of against the grain of diesel. So it looks as though those ARBs that are coming in from the east into the west should now be pointing into Europe rather than the US. So putting a ceiling on the US and hopefully a floor under the US dynamics, although the US maybe has its own issues, it seems, with kind of lower consumer confidence and potentially lower than expected aviation demand. But looking forward, and this applies to diesel as well as it does to jet, the main thing to keep an eye on here will be the Suez and whether or not the Suez routes are opening consistently or not through the Suez Canal rather than via the Cape, because that is going to give us a higher baseline for east-west spreads, both on diesel and jet. And with those Atlantic ARBs now pointing very much towards Europe rather than to the US, as I said, very much capping European jet and maybe putting a floor under US jet diffs. But that's a very kind of high-level view on clean products markets and the residue cracks at the beginning. But to look in the global refinery margins outlook in a bit more detail, I'd like to invite June onto the stage, and I will bid you adieu.
All right, thanks, Phil. So I will now bring you across all the different refinery margins in the regions. We will start first with Asia. All right, so simple margins are currently positive in Asia. And when we track back in January, margins were actually very poor due to the OPEC sanctions and causing the MEG crude premium to spike. And it resulted in sort of like underbuying and run cuts for March barrels trading window. Then what happened subsequently in February, the margins was very strong as product cracks then responded to the underbuying of the crude in the previous month. And these are particularly felt in those cracks that were most exposed to the simple margin, i.e. the high sulfur fuel oil and the naphtha crack. The charts on the right, the top one will show you our Sparta Southeast Asia indicative margin in blue, and the naphtha and fuel oil cracks tracking very much closely the margin, simple margin up till February. The chart below is the medium margin for Oman in blue, and Mars up actually is the red color line, which interestingly Mars was actually open versus Oman back in February. Okay, but is this strength expected to last? We don't think so. We are seeing refineries coming back from turnaround. So distillate cracks in particular are trending down. The top left charts are both the SG10 crack and the Sing 92 crack, and they are both falling in the recent week or so. Additionally, high sulfur fuel oil cracks is unseasonally strong. The bottom left chart shows you the seasonality chart, where the red line is right now kind of at its peak compared to the historical 5 years. And why is this so? We are thinking as well that Chinese independent refineries were actually quite worried about the OPEC sanctions in January. And we are now seeing signs that They are already buying again, both Iranian and Russian barrels, and therefore their run rates can go up. So the market here will be again supplied by products. Okay, I'll move on to Northwest Europe. We have seen now the margins for Northwest Europe in up till Feb. Also on the uptrend is indicated by the top right chart, blue color line. And similar to Asia, it was buoyed by strong naphtha and fuel oil cracks, signaling a tight intermediate market. The chart below is the 40s medium margin in Northwest Europe. And there was actually a glut of light sweet crude back in February trading for March barrels due to the turnaround period in March. Additionally, ICE gas oil rallied with heating demand and low inventories back in February. Again, is this going to last? We don't think so. March cycle for April buying is when refineries have come out of peak turnaround. Additionally, we are watching very closely the impact of Dangote gas oil barrels coming into the market as they run up to higher capacities. North Sea premium right now looks a little bit strong from an up perspective. How do we see this? In our crude dashboard, we looked at the Far East margin. I refer to the chart on the bottom where it is a Melbourne. The Melbourne line landed to Far East is the blue color line, whilst the 40s line is the red line. And right now, the red line, which is the 40s line, is diverging out from the Melbourne line. So it looks very strong going from our perspective. Also for high sulfur fuel oil, is it also a little bit on the high end side, and therefore it might come off in terms of overall refining margin. So that's something that we're all watching in Northwest Europe. In the US Gulf Coast, the 3-to-1 crack spread has jumped. We have seen significant draws, particularly in the distillates pool in February, that propped up the US Gulf Coast margins. US also is coming out of TA period from Jan-Feb. And for the margins that we are calculating, currently there's no import tariff baked into that margin calculation. So how does then the tariff is expected to impact the margins in US Gulf Coast? It will have a very uneven impact. In PET 2, margins will likely be hit the most simply because there's not much alternative crude to get from, and Canadian producers therefore will need to absorb some of this tariff impact. PET 3, however, will need to find alternative waterborne heavy crudes, which increases the cost of delivery. The chart on the left is showing the landed price of crudes coming into the US Gulf Coast. The green line is the Maya delivered to US Gulf Coast, and you see a sharp spike in the early March period. Those are the three days where the import, the 25% import was actually implemented, and Sparta had modeled it as well. That line actually shows that it is more expensive than two other crudes arriving to US Gulf Coast, which is Arab Heavy and Lisa. So it means that it's not sustainable as a feedstock into US Gulf Coast if the tariffs were implemented sustainably. As a result, utilization may be lower for PET 3, and this is a mild bullish sign for ICE gas oil. The big question that we all have is, what if Russian sanctions were lifted and Russian residue, the M100s, come back into the US feedstock? In that case, it actually works out to be a good blend with WTI, which is a light crude, to be a look-alike to the typical alternatives of the Canadian crude. Okay, I will now hand it over back to Neil for the Q&A session.
Thank you very much, June, for your insights there on refining margins. I think we had a very nice session there, including a contrarian view on the ECA zone from Hoa, which is great. That sort of reminds me of the IMO 2020 spec switch, where gas oil was deemed by the market to be the main solution right up to the last minute. And we got something of a rug pull in the end. But let's leave that for the Q&A maybe, which means everybody's here on stage again. It looks like I'll be the quiz master for us. We'll get to a few of these questions. We won't get to all of them, maybe 5 or 6, but let's get started with the first one. So the first one is for Hoa from Hugh. Let's answer this live. Wow, so 850 KT lost VLSFO demand in the Med and 200 KT LSSR can be absorbed into ULSFO blends. Is that correct?
So the reality is the current consumption in the Med is around 850 KT VLSFO per month. Not all of that will be lost. I think the amount that will be lost in terms of the amount of VLSFO is probably closer to around, say, 400 to 400 KT a month, and then part of that will get absorbed into the ULSFO blending pool, and then part of the other end will also get absorbed into the high sulfur blending pool. For those molecules are closer to like 1.2 to 1.3% sulfur. So in terms of the additional molecules that will get out of the Met, maybe go to other regions, it's probably close to like 1 or 2 Suezmaxes a month. So.
Okay, very good. Thank you. And one more from you before I take another for someone else. What percentage of current scrubber fleet can use HSFO and still meet the ECA requirement? That's from Sudar San.
That is a pretty difficult question. I don't think I have an exact figure off the top of my head. It is definitely true that scrubbing from 3.5% to 0.1% is hitting the upper technical limit for some of the older scrubbers in existence. But I think there are additional technical adjustments that can be made to those scrubbers to do the scrubbing down to 0.1%. So it's not that those will forever, like not be able to scrub down to 0.1%. It's just that you need to make some adjustments that may take a little bit of time to kind of kick in compared to the newer scrubbers in the market.
Good stuff. Thank you. Well, I'll give you a wee rest. One for you, maybe, Phil. If US sanctions were dropped on Russian crude, resid, gas oil, what could change about the price outlook?
Yeah, quite a lot is the short answer. So it depends on a lot of things, and depends on kind of what's happening at the same time, right? If US sanctions are dropped on Russian crude, but there are tariffs on Canadian and Mexican barrels, then maybe that kind of equals out. If there's no tariffs on the Canadian and Mexican stuff, then essentially what we would expect to happen would be that we would have then a much more kind of consistently open, probably US Gulf Coast back into Europe distillate arb. So we would have, it would be improving the margins on US Gulf Coast, in particular refining. As well as obviously, if some of that gas oil could go into pad 1, but I think the biggest impact would be into pad 3 in terms of giving the refiners there the residue that they've been kind of starved of over the last couple of years, which is going to overall impact their yields and their runs. So we would expect more clean product exports to come out of pad 3 and broadly higher margins for that region.
Very nice. Not a particularly easy one, that. Okay, I have one for you, June. There are a fair number of capacity closures due in the US and Europe this year. What is the impact on margins in your view?
Well, I think we need to weigh the capacities involved. Generally, the KBD wise, they are not significant when you compare to the capacity that they are coming online. For example, Dangote is probably still not at the max utilization yet from its 650 KBD nameplate capacity. Whilst Dos Bocas we are still all waiting for the 340 KBD to come online. And we have Yulong refinery, which in China, 400 KBD was started up. Another 400 KBD is coming second half of this year. So there's so many other online capacities that will, the closures are not going to impact that much.
Yeah, we're always waiting for dust buckets. Seemingly, we've had a fairly nice discussion internally, also on our podcast, the last few weeks. There's a bit of a divergence between, let's say, what the flat price or even gas oil cracks themselves are telling us the last couple of weeks versus what spreads are doing. So just looking at the expiry of March ICE gas oil, things are looking pretty tight in the prompt, and crude spreads look the same. So we've been through some of the reasons potentially on gas oil in terms of a cold winter. So we'll get to see in the medium term what the real gas oil crack will be from a kind of medium term perspective. But things at the prompt in many parts of the oil market at the moment look quite tight in contrast to, let's say, what the flat price signal is telling us. So finish answering that. I have a couple more for you, Hoa, if you don't mind. Is there a ULSFO price already? What is the current spread to MGO?
Yes, in ARA, there is a small market, or at least in the North Sea, there exists a small market for ULSFO, which as we said, is roughly, I think, 125 to 150 KT a month currently from our estimates. The pricing for this is a little bit more opaque, and this 0.1% residue is only offered, I believe, at the small number of ports. And the last time I talked to a supplier in that region, the ULSFO, it seemed to be trading at around, I think, a $40 to $50 discount to MGO at that point. So it's really not too far away from where we expect the discount should be for the ULSFO market to exist. But I think we probably need a little bit of a bigger discount than the $40 to $50 that I just mentioned, probably closer to the 50 to 75 dollar range, maybe even a little bit higher to incentivize the ship owners to really switch to that.
Good stuff. Last one, I think. So we're rapidly running out of time, but I think we have one more. And Hoa, you are the man of the hour, the fuel oil expert. So this one, you mentioned blending straight run resid with straight run gas oil would tend to have fewer compatibility and stability issues than blending with LCO. Why is this the case?
Well, it's not the answer to this question can get quite technical, and it's not always the case, obviously. And but in simple terms, you can think of fuel oil as a colloidal solution of asphaltene molecules surrounded by a sea of aromatics and resins molecules, and any disturbances to this configuration can lead to precipitation, which causes the problems with stability and compatibility. So straight run residue or gas oil are generally very paraffinic by virtue of them being straight run. LCO, on the other hand, is a cracked component coming out of the FCC, so it's highly aromatic in general. Now, if all of your components are cracked and full of aromatics, that's very good. Your fuel oil blend tends to be very, very stable, so very, very good. If all of your components are straight run and paraffinic in nature, the blend, I think, also tend to be pretty stable in general. The problem really comes when you mix the paraffinic with the aromatics. So in most cases, if you want to ensure the stability, you really need to ensure that the aromatic content dominates the blend to maintain that that stable configuration, the stable colloidal suspension that we just talked about. So a lot of problems that we saw with VLSFO compatibility and stability in the past really had to do with like blending these deal in different streams of very different nature. So
Good stuff. Thank you very much indeed. So unfortunately, we're out of time. I'd like to thank you all very much for your participation and engagement today. It's been a pleasure to have you with us. Thank you also to our wonderful speakers. Hope you all enjoyed what we had to offer today. A recording of this webinar will be available shortly. Please check your email and our social media for the link. If you're new to Sparta and would like a demo of our platform, feel free to email us again at sales@spartacommodities.com or visit our website. So thank you very much again and have a wonderful rest of your day.